Friends, welcome to the channel JAIIB and CIB Made Simple. This is our 10-minute miracle series. In this session, we are going to revise 3 units 33, 34 and 35 of PPB. Since these units are very smaller, that's why I have merged all these 3 units in a single video. In the next 10 minutes, you will be able to revise all the important content related to these 3 topics in the simplest way possible. The topics are Deferred Payment Guarantee, law relating to bill finance and personal finance. I will make you understand the main concept of these 3 topics in the layman term possible so that you can solve any kind of MCQs based on this. So after seeing this video, your next task should be to solve MCQs based on this, and you try it in the comment section whether this video was useful or not. So without wasting our time, let's begin with the first concept that we have. So in the first slide, we are going to break down a key concept in banking that is called DPG. What is DPG? Deferred Payment Guarantee and Bill Finance. So now a DPG is a promise by the bank to pay for goods bought on installment. Imagine you are buying a machine but can't pay the full amount. So you are buying a machine but can't pay the full amount upfront. The seller agree to let you pay over time, but they want assurance. Obviously, seller will need assurance, right? So that is where the bank steps in and guarantee your payment even if you can't. Right. So I have given you an example. You are buying a machine, seller is trying to and you want but can't pay the full amount upfront. The seller agreed to let you pay over the time, but he want assurance, and that is where this particular bank step in and guarantee your payment. Now how does it work? You see, it's quite simple. Usually it's you pay 10 to 15% upfront, right? Another 10 to 15% when document like letter of credit are received, and rest in installment over 9 to 7 years. Usually you pay 10% upfront, 10 to 15% when document like letter of credit are received, and the rest in installment over 1 to 7 years. Now the bank does not check the quality of the goods, it guarantee the payment. That's the rule. Bank provide unconditional payment guarantee, does not verify the goods quality. Now the guarantee is unconditional, meaning the bank must pay, no question asked. If you miss a payment, it is also irrevocable. You can see written here, it is irrevocable. It is unconditional, it is irrevocable. So bank guarantee payment of installment including interest, liability is independent of the contract. Now the guarantee is unconditional, meaning the bank must pay, no question asked, and irrevocable means once given it can't be taken back. That is the meaning of this irrevocability. Hopefully you have understood. Now let's talk about the bill finance. Right, so let's talk about something more important called bill finance. This is when bank help businesses by buying or discounting commercial bill, either by discounting, either by purchasing the commercial bill. It is a way to get quick cash while ensuring fixed payment return. So you will get quick cash while ensuring fixed repayment terms. Now there are different types of bill, like you can see written here: clean bill, documentary bill, bills under credit. Each has a specific condition, but they all fall under negotiable instrument act, that is NI Act. Now there are 3 parties to a bill, as you know. The first is the drawer. The drawer is the one who has owed the money, that is the creditor. Drawee is the one who owes money, that is the debtor, and the payee is the one who get paid. That's a quick breakdown of DPG and bill finance. Right, now let's talk about the transferability. So bills can be easily transferred. Holder in due course is entitled for the payment. Right, whoever is holding the bill and he is in due course, he will be entitled to pay the bill. Now let's talk about negotiation and endorsement. First up, let's talk about negotiation. When you transfer a bill for a money, that is called negotiation. Right, you are transferring a bill for money, for consideration. When I say consideration, I mean money. So you are transferring bill for money, that is called negotiation. And if you sign the bill to transfer it to someone else, that is called endorsement. Endorsement means what? You are signing a bill to transfer it to someone else, to third party. Now what are the liabilities of drawer? Try to understand. Here is the important part about who is responsible for paying the bill. The drawer. You know the meaning of drawer? The one who has owed money has to step in if the drawee, the one who owes money, can't pay, but only if they are notified of failure. Now the acceptor is, what is their liability? Who is the acceptor? Acceptor is the person who agreed to pay the bill. So the acceptor is responsible for pay when the bill is due. It is responsible for paying when the bill is due. And if someone endorses the bill, what is his liability? Endorser. So and if someone endorses the bill to another person, they are also liable if bill is not paid. Now let's talk about the interest rate. Interest rate on bill are either mentioned directly or if not specified, they are 18% per year. So always check the detail. Now if we talk about the types of bill classification, there is something called inland bill. Inland bill are made and payable within India. Foreign bill are made outside India but could be paid either abroad or in India. There is something called demand bill. Demand bill are payable right away, no waiting period, right? Payable on demand. As and when demand come, it will be paid. Usance bill need to be paid after a set period, like 30 days, right, after sight. Now documentary bill. So the documentary bill comes with document like bill of lading, while clean bill don't have any document attached. Now you can see there are some more types of bill you can see here, like DP bill. So let's see what is this DP bill in the next slide, right? So when I say DP bill means it required document to be handed over only when payment is made. Means once the payment is made, you will give the document. Clean bill, no document of title attached. Documentary bill accompanied by document of title of goods. DA bill. So DA bill means document to be handed over when acceptance is given. So A stands for acceptance, right? So document to be given when acceptance, document to be handed over when acceptance is given. It means that the buyer agree to pay later, right? So buyer will agree that I will pay later. Buyer agree to pay later. Remember this thing, okay? And in the case of DP bill, it requires document to be handed over only when payment is made. First you made the payment and then I will give you the document. But in case of DA bill, what it says? It says that okay, I am giving you the document, but you should pay the bill at the time, right? Now let's talk about the supply bill. Supply bill are special. Why it is special? Because they are used when drawing bill on government department for good supply. So that's your quick guide to bill in banking. Now let's see the type of bill finance. So the first type is called bill purchase. What is the meaning of bill purchase? Bill purchase means when the bank negotiate demand bill. This could be clean or come with document. So whenever bank negotiate demand bill, and I already told you what is the meaning of this negotiation, right? Do you remember what is the meaning of this negotiation? Just I have told you that how does this particular term negotiation work. See, in the previous slide, let's see what is the meaning of negotiation. You can see that transfer of bill for a consideration. You are transferring the bill for some payment, right? Giving the right to that is called negotiation. And in the case of bill purchase, the bank negotiate demand bill. It can be either clean or it can be either documentary, right? Now let's talk about the next part, that is our bill discount. So this is another kind of bill finance. So when I say bill discount, it means here the bank buy usance bill but at a discount, meaning they pay you less than the face value of the bill. That is called bill discounting, right? So they buy the usance bill. When I say usance bill, what does it mean? That payment will be made after a certain date, right? So bill purchase means when bank negotiate demand bill. See the kind of bill. If it is demand bill, then negotiation will be done. If it is usance bill, then bill discounting will be done. Remember it. Okay. And something called ABC, advance against bill for collection. The bank gives you an advance while the bill are being collected. Now what is the usance bill due date? See, usance bill is due on a specific date after being presented to the buyer. The bank become the holder in due course. Obviously of this bill, the bank become holder in due course, as you can see written here. And meaning they have the right to get paid. Even if the bill is dishonored, the bank can recover the amount from the borrower. If the document like bill of lading are involved, ownership of good can also transfer with endorsement. Now let's talk about the legal framework, that is NI Act 1881. All of this is governed by the Negotiable Instrument Act 1881. It defines the rules for bill of exchange and outlines the debtor-creditor relationship between the parties. Right. Now let's talk about this co-acceptance facility. Sometimes the bank might co-accept a bill with a borrower, meaning both share the liability. It is a way for bank to offer support but also share the risk. Now let's move on to our next topic, that is our credit card. You can see credit card, this card let you make a purchase without paying upfront. The credit is offered by the bank and you pay later. Now what are the parties involved? Card holder, like that is you, the issuer, that is the bank, the merchant where you use your card, merchant acquirer who help in process the payment, credit card associate like Visa or MasterCard. What is the benefit for card holder? The first is cashless purchase, instant free credit period, ATM withdrawal, proof of purchase, and then they have additional benefit like insurance or discount. What is the benefit for merchant? The for merchant, credit card means more sales, means happy customer and less need for offering credit themselves. Now let's talk more about this particular credit card. So what is the RBI guidelines? What are the, I've told you the advantage and disadvantage, convenience, security, etc, etc. Okay, what about the RBI guideline? So before issuing a credit card, bank or NBFC must follow a strict KYC rule, that is know your customer rule, to verify your identity. They also use direct sale agent, that is called DSA, direct sale agent, to promote card, but it is the bank job to assess your credit risk and decide whether to use the card. Now what are the key requirements for credit issuance? Whether when you apply for a credit card, you will get a key fact statement. What you will get? You will get a key fact statement with all the important details. If your application is rejected, the bank must provide a written explanation, and don't worry, bank can't report your credit information until your card is activated. Remember, that is what, no credit info reported before card activation. Transparency and terms. See, everything must be transparent. That when I mean to say everything transparent, that is EMI conversion. That it should be clear, and any loan offered through the card have to be follow RBI guideline. Insurance tied to the card. Right, if insurance is tied to the card, that require your written consent, including detail of the nominee. Now let's talk about the types of card. There are different types of credit card like co-branded, corporate and add-on credit card. Bank must explain the terms and let you know how long it will take to issue the card. One key rule is that cards that are sent deactivated can only be used once you accept and activate it. Now let's talk about how to manage your credit card. So you can see card issuance and management. So banks are required to give you all the terms and conditions upfront. If they want to change anything, they have to notify you at least 45 days in advance. Remember it. Your card security is a big deal. Card now come with EMV chip, right? The card, any card that comes with EMV chip and require PIN for safety, right? And if your card is lost, it must be blocked immediately. You will also get an SMS or email alert for every transaction, and there is something called two-factor authentication for online purchases, right? If something goes wrong like incorrect billing, the bank has to fix it within 30 days. Remember it. These days are very important. It can be asked. It has to be fixed within 30 days. Remember it. Now the next thing is that if your complaint is not resolved, it get automatically escalated to a higher officer. To keep your card into information safe, many banks use something called tokenization. Right, so there is something called tokenization which is used. These which replace your actual card detail with a token for safer online transaction. Right, now let's talk about credit card eligibility and uses. See, first up, let's take the eligibility for credit card. The bank will check things like your income, your credit history, and to decide if you qualify. When it comes to uses, cardholder must comply with law, and the bank has to be clear about any fees, charges, and interest rate. Remember, no ads on card for minor, and the main credit card holder is responsible for all transaction. Credit card have limits, and if you get an add-on card, it will have a lower limit. If the bank lower your card limit, they must inform you with reason, and for a statement you will receive a monthly statement showing all your transaction either by post, email or online. And before reporting a default to credit information company, bank must follow proper procedure. Right, now interest rate need to be reasonable and transparent, especially for free cards. Bank must explain how financial charges are calculated with example. You will also get enough time before interest charges kicks in, and they must clearly state the annual percentage rate, that is we call it APR. You can see written APR must be quoted with calculation example. Even if you made a minimum payment, interest will still apply on the remaining balance. The bank must give you at least 1 month notice before changing any fees or terms. So this is called APR. Sufficient time should be given, right, before interest charge kicks in, and they must clearly state the APR, that is annual percentage rate. Now let's talk about the want to cancel your card. The process should be quick, and the bank must confirm once it is done. Now home loan. This loan can be used to buy a house, right? As you know, so the loan amount depends on your income, age and the cost of the house. Repayment period can goes up to 30 years, not exceeding retirement age or 70 years. And just like credit card, your credit history plays a big role in getting the loan. Bank checks your credit score and past financial behavior before offering terms. And let's talk about the home loan security and finance. So when you take a home loan, the property is typically mortgaged to the bank. In many cases, your spouse or joint owner can also act like a co-borrower or even guarantor for the loan. The interest rate on the home loan can be either fixed or floating, depending on the bank policy. Fixed rate stays the same throughout the loan, while floating rate changes based on the market rate. Home loan cover a wide range of purpose. You can get a loan for buying a plot with the intention to build on it, purchasing a home, constructing a house, or even making repair to your property. Some loans are also available for second home or rental property. Now if you are building or buying, you will need a sanction plan and completion certificate, right? You also, bank typically won't finance properties unless you use for commercial purpose. Now bank must make sure to inform borrower about the risk and liability involved in the loan. Keep in mind the interest rate you will get depend on the loan tenure and how long you plan to repay the loan. If you need any additional funding for house alteration or repair, bank offer extra loan, right? That is called supplementary finance. However, there are some restrictions. Bank don't finance property like government or semi-government offices or non-commercial project, right? Now lending to housing intermediary agency, what it is all about? See, the first, bank can finance public agencies, not private builders, right? For land acquisition and development as a part of complete project. The loan amount is based on the acquisition price minus developmental cost, you can see, and plus the development cost, and the market price is usually the collateral. For housing finance institution, that is called HFC, bank can provide term loan based on factors like what is the institution based debt to equity ratio, track record, and recovery performance. Bank can also give loans to the state housing board, public agencies, but they need to be ensured to prompt recovery. For private builder, bank offer credit for a specific project on commercial term and must monitor carefully to avoid land speculation. Now there is something called term loan for agencies. So a term loan are allowed for direct lending to intermediary agency, but they must stick to the RBI norm. Next comes LTV ratio, very important. That is called loan to value ratio. What is this LTV ratio? See, how bank decide the amount of loan they can give based on the price of property use. Generally, stamp duty, registration, documentation charge excluded when calculating LTV. So however, for loan costing 10 lakh or less, these charges can be considered. Now, while applying for a home loan, you will need some key documents, including the sale agreement or deed, and a nil encumbrance certificate, a 30-year title search, and the approved building plan, patta, and valuation report. You will also need to provide 12 months of your bank statement, right? Your salary certificate, IT returns, KYC, and of course your KYC document. There typically processing fee of around 1% of the loan amount. And then the loan documentation must also include the insurance for building covering risk like fire, earthquake, and flood. Plus, to make EMI payment easy, you can set up an NACH, that is National Automated Clearing House, that have wrap up on how bank finance housing intermediary. Now if we talk about the personal loan, they are typically offered without any tangible security, which means you don't have to place any asset. These loans are available to salaried employee, pensioner, and professional. For salary loan, bank usually offer them to permanent employee who have been working for at least 3 years in the government job, well-known companies or corporate organization. The loan can help cover things like marriage, education, medical expense, or household expense. Now if we talk about the eligibility, so eligibility for the loan is based on your income, whether it is your gross or net salary. Loan amount can be higher if your employer agreed to directly remit EMI to the bank. Sometimes if you don't have collateral security, bank may ask for a third party guarantee. Your employer can also give an undertaking to help your EMI recovery. Lastly, you will need to submit some key document like proof of employment and salary certificate. So that's all about this particular lecture. Hopefully you enjoy it, and if you want such kind of PDF which I have created for each and every unit, you can enroll in our PPB capsule course program. The detail regarding the capsule course program is available in the description section of the video. Thank you.